Hey, what's up everyone, and welcome to the School of Personal Finance. In this video, we're going to talk about the basics of credit cards, the things that you should know that you might not know. Now, this is the first video in a credit card series that I have available on the schoolofpersonalfinance.com. So after this one, please go check out the other videos in that series to learn more. All right, so let's start at the beginning. A credit card is just a line of credit that the bank makes available to you to borrow their money, pay them back, borrow the money again, pay them back. It's considered a revolving line of credit. Your credit card will come with a limit. That is the maximum amount that you could spend on the credit card. So once you reach that limit, then you no longer have any access to borrow their money. You have to pay some of it down before you can borrow it again. Most credit cards will also allow you to take cash advances, which is to just withdraw cash against your available limit, and also to write checks against the limit that you have available to you. So in order to get your hands on one of these things, the first thing that you have to do is apply and get approved. Now, if you've never had a loan before, or if you've never had a credit card before, then you might not have a credit score. That can make it difficult to get approved for a credit card. If you find yourself in this situation, there are a few things that you could do. The first one is you could get what's called a secured credit card from a bank. Now, not many banks offer these, and what it is you have to put up the collateral. So say, for example, you could get a $300 credit limit. You have to actually deposit $300 in the bank as security for that credit card that they're going to issue you. So it's just a way to start establishing credit. Another option would be if a bank offers a student credit card. And then the third option is to ask a family or a loved one if they will add you as an authorized user on their credit card. So they don't actually have to give you the card and let you go charge it up on them. But what they're doing by adding you as an authorized user is the bank will then report to the credit reporting agencies that you have access to this credit card, and it will start helping you build credit. Once approved, the bank will decide how big of a spending limit they want to give to you. It could be a $500 limit, a $5,000 limit, a $20,000 limit, whatever it is. Once you receive your card in the mail, you can now swipe it all around town. You now have access to that credit line right in the palm of your hand. You could go on Amazon, buy yourself some new stuff, take some friends out to dinner, go to the local bar, buy everybody a round or two. Obviously, you should not do any of these things, but you'd be surprised how many people actually do. The credit card companies love people with the buy now, worry about it later mentality. And unfortunately, many people fall into that category. Credit cards have a lot of little rules and nuances that you want to understand before you start using them. The best way for me to be able to teach you is for us to actually look at a statement together. So let's do that now. All right, so here is a real life example of a credit card statement. So this is a Chase Visa Marriott Rewards credit card. So right up on top, we could see what our outstanding balance is, this $3,873.14. And then right below that, it shows our minimum payment due, which is 1% of the outstanding balance, so $38. And then below that, we have the payment due date. So this one happens to fall on Christmas, December 25th, 2018. And then to the left, they show a little calendar so you could see what day it falls on. Then if we look right below that, it shows late payment warning. If we do not receive your minimum payment by the date listed above, you may have to pay a late fee of up to $38. And this is no joke. If you're 1 day late, they will bang you with a $38 late fee. Now, most banks, most credit card companies, they will waive that fee if you call and complain about it, but not if you're consistently paying late. So if this just happens once to you, if you forget to make the minimum payment and you call them up, they will, I would say 90% of the time, remove that fee as a courtesy for you. And then below that, we see minimum payment warning. So this is pretty interesting down here. This shows that if you were to only make the minimum payment, it would actually take you 17 years to pay off this credit card. Now remember, we only owe $3,873 on this card. So if you only make the minimum payment, which in this month is $38, it will take 17 years to pay it off, and we will end up paying a total of $8,881. Like, that is crazy. Then if we look right below that, it shows that if you were to make a payment of $140 per month, it would take you 3 years to pay it off. And the total of payments would be $5,049. And then they show savings below that as if you're doing good by paying $140 a month. But either way, it sucks. You have to pay the entire balance off so that you're not paying these high interest rates on these credit cards. Now, if we look up on the right-hand side, this is a Marriott Rewards card. So you earn rewards points, when you spend money on them. And, for this one, you could see it had a $75,000 bonus, which you could earn in the first 3 months after you spend, a certain amount. I believe it was $3,000. So now if we scroll down, we could see the account summary. So here it shows your account number. It shows the previous balance. So we had a 0 balance going into this statement. All right. During this statement, we paid $700. And we had purchases of $4,478.14. So now the fees charged, it shows $95 in fees. That was the annual membership fee. So this card carries an annual membership fee. So you have to make sure that the rewards are worth the fee that you pay to have the card. And then interest is 0, and now it shows our balance of $3,873.14. And then we see the opening and the closing date. These dates are actually very important, and we're going to circle back around. I'll talk a little bit more about the opening and the closing date in a little bit. And then we have the credit access line. This is how much you have available to you, $19,000. The available credit, which is just the $19,000 minus your outstanding balance. Then we have the cash access, which is the amount that is available for cash advances, which, again, you never want to take a cash advance on these cards. This page shows all the account activity. So again, where we saw in the summary, there was a $700 payment, and then it breaks down each purchase. So these are all the purchases that happened throughout this billing cycle. And then it shows the fees charged, so the $95 annual fee, and then the total fees charged in 2018 and the total interest charged in 2018. So you get a little snapshot of how much you paid in interest for the year and how much you've paid in fees for the year. And then this section here shows the interest charges and the interest rates. So now we did not carry a balance on this credit card. So there is 0 balance that is subject to the interest rate, and there's 0 interest charges. We don't have any cash advances here, and we don't have any balance transfers. So these are all zeros. Let's say that we did not pay off our entire balance the previous month. So let's say that we let $5 carry over to this billing cycle. What that would do is cause all of our purchases throughout this billing cycle to now be subject to this annual percentage rate starting from the day that we buy them. So let's say, for example, we made a $2,500 purchase on the first day of this billing cycle. So the way that this card works is the annual percentage rate is 17.99%, and it's charged on the daily balance method. So let's just say our 17.99% interest rate divided by 365 days. Some banks might use 360 days, but let's just assume they're using 365 days. This would be the daily interest rate that we would have to pay. If our daily balance is $2,500, that means that we would be paying $1.23 per day interest for that $2,500 balance. So over the course of a month, let's say 30 days, we would owe about $37 in interest on the $2,500 balance. And that's all because we did not pay our balance off in full the previous statement. So if we did pay our balance off in full, then we would owe nothing. We would have 0 interest on these purchases because we paid our balance off in full the previous statement cycle. And now this second line item here, cash advances. So if you take a cash advance on this credit card, right? Let's say you go to the casino and you hit the ATM and you do a cash advance on the credit card. They're going to charge you 26.99% interest starting from day one, as soon as you make that cash advance. And on top of that, they usually charge you a percentage as a fee as well, maybe 3% as a cash advance fee. So cash advances are by far the worst thing you could do with a credit card. The interest rates are astronomical, and it just doesn't make any sense to do it. So you should really try whatever it takes to not do a cash advance on your credit card. And now this third item here is balance transfers. So balance transfers can be tricky. Some cards will offer you a promotional rate where you could transfer the balance from one card to another, get a 0% promo rate for, let's say, 12 months. Right? If you have that on your card and you have this 0% balance transfer rate, then what you have to be very, very careful of is if you use that card to make purchases, when you make payments to the card, they are going to apply your payments to the 0% balance transfer balance. So let's say, for example, you transfer a $10,000 balance from an old card over to one that's offering you 0%. So now you have $10,000 that you're not being charged any interest on, and it's going to last for 12 months. And then let's say in the first month of having that card, you go and you charge $2,000 worth of purchases. Right at the end of that statement cycle on your due date, you make a payment of $2,000 thinking that you're paying off the purchases that you made that month. But what's going to happen is the credit card company is going to take that $2,000 and they're going to apply it to the 0% promotional balance of $10,000. So now you'll have $8,000 remaining at 0%, and the $2,000 in purchases, you're going to be charged this 17.99% on that amount. And it's going to continue that way until you pay off the entire amount that is at the 0% promo rate. And then once you're done with that, then your payments will start going towards paying down this higher rate balance that you have. So it is very important that if you do a balance transfer to a new card, that you do not use that card for anything after that. Lock it away. Don't use it. All right? All right, so let's come back up here and look at the account summary again. Now, if you see here, we have the opening and closing date, 10/29/18 to 11/28/18. Right? But if we scroll up, we see that the payment due date is not until December 25th of 2018. So what that means, assuming again that I did not carry a balance over to this statement, which in this example I did not. My previous balance was 0. Let's say that I make a purchase on October 29th for $5,000, right? I go and I need to have car repairs worth $5,000 and I use my credit card. So this statement closes on 11/28/18. Right? So I would not have paid interest at all during that entire time. Right? I make the purchase on October 29th. The statement ends on 11/28. And now as long as I pay off the entire balance by the payment due date of December 25th, I actually would not pay any interest during that entire period. So most cards have what's called a grace period. It is the period from the closing date of the statement cycle all the way up until the payment due date, right? So any purchases that I make during this period here, I do not actually have to pay them off until that due date of December 25th. So I have a 21-day, it's usually a 21-day grace period, but it could be 21 to 25 days depending on the card. By law, the credit card companies have to send you out your statement 21 days before the payment is actually due. All right, so this could be very advantageous if you know that you have some big expenses coming up and you could time them. The best time to make those purchases are the first few days of the statement cycle, because now you're going to give yourself, really like 45 days, 50 days or so before you have to pay it off. But you want to make sure that you pay off that balance in full. All right, if you were to have carried a balance, if this wasn't 0, if this was, $10, then my grace period goes out the window. Then I am getting charged interest from day one on every purchase that I made throughout this billing cycle. All right, so in wrapping up, here are the biggest takeaways when it comes to credit cards. Number one, credit cards can bury you. If you're not financially responsible, if you don't pay your credit card bills on time every month, if you have unsecured debt, if you live paycheck to paycheck, if you have no savings in the bank, then you should not use credit cards. They can literally ruin your life. Number two, recognize that using a credit card is so easy and convenient. It feels like you're not even spending any money. But the fact is, you're going to have to pay this bill soon. And if you don't have the cash available in the bank account to pay that bill, then you shouldn't be using the credit card. Takeaway number three, it is super important to pay off the entire balance by the due date. If you could follow this one rule, then credit cards can be your friend. Number four, never take a cash advance or use those checks that come in the envelope with your credit card. They usually have transaction fees, the interest rates are much higher, and there's no grace period. The interest starts accumulating on day one. Do not use them. Number five, the balance transfer game can work. If you get a great offer for like a 0% for 15 months with no balance transfer fees, it might work for you if you have credit card debt that you want to consolidate. But you have to be very careful. This is a slippery slope. It is not a good idea to do this if you're just going to continue your old habits of charging on the card and not being able to pay it off. And it's super important to remember that if you do a balance transfer, the card that you transfer the balance to, you cannot use that card for purchases. You have to take that card and lock it away until you pay off that balance transfer. Or else any payments you make, they're going to apply to the 0% balance. And on new purchases, you will start to accumulate interest on those that you will have to pay back. So do not use the card that you transfer the balance to. Very important. And finally, takeaway number 6 is be organized. I've seen so many people miss a small minimum payment because they didn't realize when it was due. And then all of a sudden, their interest rates go up. They have to pay a late fee. If they had a 0% promotional rate on that card, it becomes null and void, and you now go to the default interest rates. It could be a disaster. So you have to make sure that you keep up with due dates and making at least the minimum payment to ensure that you're not going to get charged those late fees and those penalties and higher interest rates for missing a payment. Not to mention that if you miss a payment for long enough, they'll report it to the credit reporting agencies, and now your credit score will suffer. Now, with all this said, I do use credit cards for all of my everyday purchases. I use them for the travel rewards. So if you are good with money and financially responsible, and you enjoy staying in hotels and going on awesome trips and vacations, then please go check out the video that I did on travel rewards programs at the School of Personal Finance or on my YouTube channel. Thank you so much for watching, and I will see you again in the next video. Thanks.